Good morning, good afternoon, wherever you are in the Americas. Today's webinar is about brand resilience in relation to price elasticity. And we believe that strong brands have a better opportunity to raise their prices because of their brand's resilience. And we believe that's true because price elasticities are low and the loss of volume will be overcompensated by the price increase. So what we do is define brand resilience as the brand's ability to charge a premium, to withstand a price increase and minimal loss of revenue. We believe in our business that brand resilience and price elasticity are one and the same. And in our presentation today, we'll describe how we can assess brand resilience by looking at price elasticity. Ellen, up to you.
Yes. So we know that setting the right price is vital because price is a key marketing lever and it expresses brand value in a competitive context. The question is, how far can a brand increase prices while still securing revenue? The answer is up to the point where the price change is no longer offset by the perceived value of the product or service. The tipping point depends on the brand's and product's price elasticity. The brand can only raise prices without being penalized if elasticity is low. So the key is to focus on setting the right price in balance with the brand's value. SKIM's meta-analysis of over 200 pricing studies provides valuable insights on how to achieve that balance. The analysis covers a wide range of categories, brands, and retail channels across countries. Here, the focus is on variations in price elasticities across brands, pointing to variations in their brand resilience. The results are applicable to virtually any retail brand. Back to you, Gerard.
Thank you, Ellen. So what is price elasticity? Well, price elasticity, we define that as the variation in demand for a product or a brand as a function of price changes, or the slope of a demand curve at a range of prices like in this chart. So as indicated by the curve in orange in this chart, the relation between price and demand is not linear. It curves between demand going to infinity if price goes to zero, or to demand to zero if price goes to infinity. So basically the price elasticity value that we will provide you from our studies is the slope of the curve at price P1 or P2 or any point of that curve, or in our computations between the two price variations, P1 and P2, for example, a base price or a scenario price, which turns it into a slope estimate. So basically, it all hinges now on low or high price elasticity if it comes down to brand resilience. So let's start with low price elasticity. Low price elasticity means that the price change causes a small change in demand, indicating a high brand resilience. The brand is actually resilient against any price changes that you do in the market. If you look at the price elasticity metric itself, it is between 0 and -1 for up pricing it is. And it means that if you increase price, volume demand will go down a little bit, but not to the extent that it is actually overcompensated by the price increase. So revenue goes up. That means that there is a high brand resilience. High price elasticity means that a price change causes a big change in demand, indicating a low brand resilience. Actually, sales revenue volume goes down. It's indicated in the studies by a price elasticity metric of -1 to -infinity. And as I said, price goes up, volume goes down so much that revenue goes down with it. So there are two rules of thumb that you can remember concerning high brand resilience or low brand resilience, the according price elasticity metric, and that is if the price elasticity metric is between 0 and -1, the brand resilience is high, the business benefits if you turn up your prices. If price elasticity is between -1 and -infinity, brand resilience is low and the business will suffer from a price increase. Now let's try to explain that in a little more detail. So what we have here in this chart on the left is that if in the table, if price elasticity is, for example, low, lower, or lowest, so between 0 and -1, so 1.50 or 0.33, and if you would change your price with, for example, 10, 20, or 30%, up price it, then and demand would stay the same, basically the revenue will increase. And that is because the market will not respond so much to the increase in price. demand is pretty stable, and revenue will be gained. So much, and that is basically indicating a situation for a brand of high brand resilience. The alternative scenario is then high price elasticity, meaning low brand resilience. And what we then see in the study is that the price elasticity value is less than -1, so -1 or -2 or -5. And if we would change the price with +10%, what we could see in those price elasticity scenarios is that demand goes down with -10 to -50%, and what's worse is revenue goes with it from -1 to -45%, and that's a huge dent in the business. So this is what low brand resilience can do if you would increase your prices.
Right. So as Gerard mentioned, brand resilience is the opposite of price elasticity. Price elasticity, however, should never be studied in isolation from a competitive context. That is because the demand for a product not only depends on its own price, but on its price relative to the competition. To illustrate this, the market is pictured as a house. Each floor is a price tier and each brand a room. Doors and stairs show how demand can migrate. The nature of price elasticity and brand resilience can be seen from the metaphor of the house. Demand can move from one room to another and take the stairs up and down. Various brands can be depicted in the house to demonstrate how they are competing in the same tier and how demand may migrate between brands and between tiers. Pricing research can help brands design their pricing strategy as if it were a house, acting like portfolio architects.
So that's a nice theory to help you as an architect to build your portfolio of prices and products, SKUs and brands. But how would it work in our environment? So there we make a distinction between SKU-level price elasticity and brand-level price elasticity. Let's start with the first one. SKU-level price elasticity actually indicates how demand migrates if you change the prices of individual SKUs. So take, for example, the brand in gold, and then take the middle SKU, take up the price, and what you will see, for example, in our environment, in the study environment, is that demand migrates to another SKU, and that SKU can be from the same brand or from a different brand. Actually, volume just migrates somewhere. It goes away. This is the definition of SKU-level price sensitive elasticity, the extent to which demand or volume of the product migrates to another SKU in a situation of a price change. Brand-level price elasticity is not so much different, it's just expressed in a different way in that it shows how much of that volume stays within the brand versus going to an alternative brand. The volume migration stays the same, it's just the place where it goes. So what you will see is that most of the volume of that middle SKU of the golden brand goes to an alternative SKU of the same brand. Some of the volume goes to SKUs of a different brand. The extent to which the volume of that brand migrates to a different brand as a function of the price change, that is what we call the brand level price elasticity. And essentially what the brand wants is to keep as much of the volume within the brand and have it migrate as little as possible to competition. So what you would like to do is keep the brand level price sensitivity very low. And why would we expect actually, and that is also true, brand level price elasticity is typically lower than SKU price level price elasticity, and that is because typically consumers are loyal to their brand. So if you increase the price of one SKU within the brand, consumers would be more likely to migrate to an SKU of the same brand than that they would switch to a different brand. Now that's also a little bit of a problem, because what may happen in our studies is that usually because consumers seek for an alternative SKU within the same brand, and in our studies they may be able to always find a cheap SKU because our research designs as cheap SKU in the same brand, which means that the brand price sensitivity, the brand level price sensitivity would be underestimated because there's always a low SKU to be found within the brand. So what we do is replicate the situation that we would also typically find in market, which is called line pricing. You're probably very familiar with it, is that all the SKUs within the brand are actually increased or decreased in prices in conjunction within a certain bandwidth. And that encourages the situation that, well, it limits the opportunity for the consumers to find a very cheap SKU within the same brand. So it encourages the situation to make a very fair trade-off between staying within the brand and paying the price, or switching to another brand and paying a lower price. So we believe that that gives a very much better estimate of the brand level price sensitivity. So, and also it replicates a market reality that we typically see in our business.
Yeah. So from our years of experience with pricing studies, we gathered a lot of information about price elasticities and brand resilience. Here we show the average up-pricing price elasticity values at the parent brand level, averaging values across the individual brands within the parent. From top to bottom, we have ranked parent brands by their average brand level price elasticity. Up-pricing elasticity only describes what happens to demand if we increase prices, not what happens if we decrease prices. So what we see here is that Unilever brands are among the most price sensitive, hence they are the least resilient. Johnson & Johnson brands, on the other hand, are amongst the least price sensitive, and they are therefore the most resilient. It means that Unilever brands will, on average, suffer more from a price increase than Johnson & Johnson brands will. Also, a brand level price elasticity between -1 and 0, here applicable to P&G and Johnson & Johnson, indicates that on average there is no risk of losing revenue within the price ranges investigated. Unilever instead will lose revenue if it increases its prices, which is a sign of lower brand resilience. Oh, proceed up. Okay. So the number of studies done for the companies allows us to have a look at a deeper level as well, at the brand level. Of course, we will not share any confidential information, but in this table, we do see the brand and SKU level elasticities for a few brands within the personal care and hygiene category. It is clearly visible that Unilever brands within this category are less resilient than our P&G brands. Of the Unilever brands, X is the only brand with an elasticity higher than -1, indicating that this is the only brand that could increase its prices without losing revenue. P&G's category brands all have elasticities higher than -1, yet relatively high price indices. This indicates that, irrespective of the price, consumers are less likely to move away from these brands, thereby making them more resilient. We therefore argue that the brand level price elasticity is higher for some brands because they have not invested in the consumer's connection with the brand. Establishing a connection between the brand and consumer appears to pay off. So we talked about the brand level and having to establish a connection between the brand and consumer. But what other factors may play a part in brand's resilience? An alternative explanation is that elasticity variations are due to the tiers in which the brands are playing. The hypothesis is that top-tier brands, indicated by a higher base price, are more resilient than mid-tier brands, because brands will have invested more in their equity. Across all brands and categories, we do find that the medium tier is indeed more price elastic than the high tier, but also more elastic than the low tier. The temptation to switch is higher from the mid-tier because there are more places to go. Lower price tier products are mostly sought by consumers because of the attractive price. Consumers generally do not purchase from these tiers because of the quality or exclusiveness. Because price is such an important element in the selection of lower tier products, we expect the lower tiers to be more price elastic. However, this proves not to be true, primarily because there is no way to go. There are little options to switch away from the cheapest offerings, resulting in low price sensitivity. So do we see the same trend amongst our manufacturers in the personal care and hygiene product category? Indeed, Unilever plays more in the mid-tier, and so does Johnson & Johnson. Yet only Unilever has lower brand resilience. What we can establish, however, is that Procter & Gamble is a big player in the higher tier and has relatively high brand resilience. Though we cannot draw a clear conclusion here, it does appear that players in the high and low tier enjoy relatively high brand resilience, whereas those in the mid-tier may or may not deal with low brand resilience. It may be concluded that price tiers alone do not determine brand resilience.
So that was kind of inconclusive so far. We had hoped to draw a stronger conclusion there. So we continue to look for other reasons why brand level price elasticity, brand resilience may be different across the brands. So we continue to look at A&P expenses, comparing that with revenue, expressing it as a percentage of A&P on revenue. And what we expected is that P&G would spend much more on their A&P than, for example, Unilever would do, because that would explain why brand resilience of P&G brands would be higher. Or, for example, that Johnson & Johnson would pay a lot more than they currently do. To our surprise, what we found is that Johnson & Johnson actually has the lowest brand level price elasticity, so the highest brand resilience, but also at the lowest percentage of A&P on revenue, which means that they're pretty effective in the way they spend their A&P. Unilever and Procter & Gamble. Procter & Gamble has still, of course, this pretty low price elasticity and an A&P on revenue spend of 12%, which is not very different from Unilever, from about 11% of A&P spend on revenue. So they're not that far apart. So what we can conclude is that relative to Unilever in our data, P&G and Johnson & Johnson seem to be more effective in the way they do their A&P spend. That's not much of an explanation, but at least it's a good insight about how the brands are performing. So what to do with these pricing insights? So basically what we have tried to tell you is that you could use brand level and SKUs level price sensitivity or elasticity as a metric to express brand resilience, the ability of a brand to withstand the need for price increases. For example, if your raw material prices go up. And it's a longer term and a short term investment in the brand. So what happens at the low price elasticity is in the situation of the brand or SKU level up price sensitivity is between -1 and 0%, is that the market seems to see more value in your brand and your products than currently expressed by your price, which you can use to your advantage. You can leverage the value opportunity to move closer to the tipping point at a price where the price and value are in balance, which is a short-term sales kind of opportunity. If you're facing a high price elasticity in your business, meaning that your price elasticity values are between -infinity and -1, it seems to be the case that the market already sees less value in your brand and your products than currently expressed by price. And that's fine, but as soon as you're in the need of taking your prices up, your brand, your business performance will suffer. So what you could do or should have done in the long run is have invested in the brand, which we call then a long-term opportunity, which makes you more resistant, more resilient to the need for price increases. Now, how do we get there? We will not go into any technical details, but finding that sweet spot, that tipping point between the price that your brand can command and the premium that you can command and the value that the consumer extracts from it, finding that sweet spot, the tipping point, can be done using a PSA's price sensitivity studies, using a simulator and an optimizer, which you can use in conjunction with this portfolio architect kind of approach to really optimize the prices of all your SKUs in conjunction and in the competitive environment. So with that, I'll give back the floor to Abby, and you're very welcome to ask us any questions.
Thank you guys so much. I have here a question from the audience. What is the difference between price elasticity and price sensitivity? How do you see that difference?
Yeah, good catch, Abby. Good catch for whoever called that out. Basically, yeah, I use the words intermittently. What price sensitivity is the word that we use to describe how the consumer responds to a price change, because the consumer is sensitive to price changes. So that defines price sensitivity. Price elasticity is more of the economic business term to express how sensitive demand is, how elastic demand is to the price changes. So we talk about elasticity if we talk about the demand in the market at the market level.
Okay, great. Thank you. Well, I think we're going to close up now then. I want to thank everyone for joining us today for the webinar. And also you can visit skimgroup.com/webinars to download the presentation there. You can also sign up there for our next webinar, which will take place on December 5th. We will be discussing concept testing and SKIM's new dynamic optimization tool. We'll be sending around that link to you. So on behalf of Gerard, Ellen, and myself, I thank you once again, and we look forward to hearing from you soon. Have a good afternoon.